What's happening, traders? Welcome to another video. It's Emmanuel from LiveFree, and today we're going to be diving into a market structure trading strategy video. One of the core aspects of being a great price action trader is understanding the foundational aspects of price action. And market structure is just one of those core aspects that you have to understand. I'm a big believer that, you don't need to overcomplicate trading. You don't need to focus on the over advanced, complicated stuff. If you have a great understanding of the basics and the foundational stuff, you can build on that and you can really become profitable. So let's waste no time. Let's dive right into it.
One of the most simple and effective ways to trade price action is through the understanding of market structure. And market structure is one of those concepts that if you understand, everything else that you learn over the course of your trading education can be built upon it, because market structure allows you to understand the relationship between buyers and sellers. There are two sides in the market, right? Prices either going up or going down. Buyers are either dominant or sellers are either dominant, and outside of that you have a sideways market. But market structure is what is going to allow you to see which side of the market you should be on, and if you use this effectively, it will help you with your top-down analysis. It will help you to understand who is in control of the market, and it will also help you to gain a solid entry and price move in your favor. In this video, I'm going to be walking you through how you can essentially do that and what you need to understand with market structure. So the very first thing when you're coming into the market is understand that, hey, as a retail trader, we have buyers and sellers, right? Some might argue that there are no buyers and sellers because, the banks don't look at it from that standpoint. Well, I'm not talking to you from a bank standpoint. I'm talking to you as a retail trader. And from our perspective, we see the market with buyers and sellers, right? So price is either going up or the market's going down. And one of the ways that you can identify price going up is by the market structure. Price is either making high highs and high lows, right? So in an uptrend, the market will be making high highs and high lows. And you can also call that a bullish market. You can call it an uptrend. And when sellers come into the market, you can call that a bearish market as well, or a bearish market structure, right? We have a bearish market structure in line, and this is generally the ebb and flow of price. Buyers are coming in, making high highs and high lows, higher highs and higher lows, high highs and higher lows. And from a market structure standpoint, if you are looking at this from a higher time frame, maybe this is the daily time frame, right? What's going to happen as you scale down to the lower time frame is you're going to find smaller market structure in between these large market structure as well. So if this is a daily move that you're seeing, as you start to scale down maybe to the 1 hour or 4 hour, you're going to see price essentially making high highs. We're going to do it right here because it's just better that way. You're going to see price making high highs and high lows and forming its own market structure as you kind of move along. So within a larger market structure, right, there are smaller market structure, and the more you scale down, the smaller the market structure goes. And kind of like the same thing here, price making lower lows and lower highs, lower lows and lower highs. So when it comes to understanding market structure, you need to know that market structure is what is going to allow you to understand the relationship between buyers and sellers. And if we go into the buyer and seller concept of buyers mainly targeting the high, right? Targeting the high, that is the area that they're constantly reaching for. And this will also give you a bit of understanding in terms of where price is reaching for when buyers are coming into the market. So from a bearish market structure, if price is pushing up, right, that we are in a bearish market and sellers are going to be reaching for this low, right? So your overall focus is to try to target this level because this is where you call, an area of liquidity or main objective, right? Because sellers are targeting the lows, buyers are targeting the high. And like I said before, as you scale down to the lower time frame, you're going to see smaller market structure that make up, this large market structure if this is on a daily time frame. So that's one of the main things that you got to understand from a market structure standpoint. We're going to be taking a look at the chart to figure how you would be able to use this information in real time to get involved in a profitable trade and, you know, make your overall decision. So let's go over here. Taking a look at Euro USD, we are on the 4-hour time frame. You always want to start off on a higher time frame. You can start off on the 4-hour time frame. You can start off on the weekly time frame, on the daily time frame. These are going to be your big boy time frame or your godfather time frame. These are high perspective time frames. Sometimes I prefer to do the daily, and you know, sometimes for this video we can do the 4-hour time frame as well to gain a large understanding, because these market structures are a lot more significant on the large time frame than they are on the smaller time frame. So when you come over to the 4-hour time frame and you see that, okay, price is making higher highs and higher lows, what that tells you is that we are in a buyer's market, right? Buyers are dominant, so you should look to be a buyer. And that's just one of the basic aspects of market structure. It's pretty simple, it's not complicated, right? And what you will see here is the pullbacks are called premium price. This is where you get an opportunity to get involved in a trade that is going to move in your favor. This is generally the trades that you're looking for, that you're looking to get involved in, right? So the way you can go about trading market structure effectively is through using multiple time frame analysis. That's the main thing. So figure out who is in control. Based on what we can see right now, we know that buyers are in control and buyers are currently targeting the highs. The highs are becoming the area of objective, the areas of interest. So if this high has been taken out, if buyers are coming into the market, they are targeting the highs. So if we're in the buyer's market, the highs become an area of interest, because that's just simply how market structure works. When buyers are coming in, they are targeting the highs, and when sellers are coming in, they're targeting the lows. So it's very basic trading price action stuff. Going over to the 1-hour time frame here, we've identified an area that price can potentially be targeting. Right now, we're seeing how the market is moving and price is essentially doing its thing, right? So we've pushed up a little bit. A lot of the time, what traders are going to be looking for is you're going to be looking for a pullback maybe further down, right? A lot of traders are going to be looking for that. But the most important thing, and the reason why you don't predict where price is going to go, is because we analyze and we anticipate. When price makes certain moves, we're going to gain another understanding. But we also know right now that we don't care about whether price pushed to the downside, right? Because when you're in a buyer's market, you can't predict whether sellers are going to be coming in or how aggressive sellers are going to be coming in, because you're in the buyer's market. Buyers are dominant, and buyers can only push maybe just a little bit and then continue to move up. That's the reason why if you're in the buyer's market, you should focus on buying. So right now, the market is essentially moving sideways here on the 1-hour time frame. So once you start to scale over to the lower time frame, whether it's your execution time frame, the most important thing about scaling down to the lower time frame is time and price. Don't come into the market and look to trade when the market is not moving. So if you're trading a pair like Euro, right, you can trade it during the London session. There's no problem, right? You can trade it during the New York session. I am a New York trader. So the next thing that you want to focus on is trading this pair when there is liquidity coming into the market, even if you're dealing with market structure, because it's going to be more effective when there is liquidity. It's going to be more trustworthy when there is liquidity. So I like to come into the market at 7:30 Eastern, and I look to analyze the market, you know, from 7:30 to about 8 a.m. Eastern time, because I know that that's when I'm going to see the volume coming to the market and price is going to be setting up. So let's go over to that time zone. Right now, it is currently 4 a.m., which would be, you know, in the London session. This is about 7:45. So what I'm going to do now is I'm going to scale over to the lower time frame, the 5-minute time frame, and gain a little bit of a larger perspective. And what we can see here, from based on what price has done, as much as we would like to see price to come all the way down here, the market structure is still making high highs and high lows. Price is still making high highs and high lows. Over here, we consolidated a little bit, right? Price consolidated a little bit, but take a look at what happened right here. The market has now breached this high with this candlestick. So at about 3:50 a.m. during the London session, price broke above this level. So when you understand that when sellers are coming into the market, they're making lower lows, low highs, low lows, and lower highs. And when buyers come into the market, from a market structure standpoint, they target the high. And when a high gets taken out, what happens next is generally a continuation to the upside, and they start to continue their move targeting, all the previous highs that were set up. That is just the basic aspects of market structure from a buyer and seller understanding. What we have here is we've analyzed that one, we are in a buyer's market on a higher time frame. The market structure is making higher highs and higher lows. As we scale down from the 1 hour to the 50-minute to the 5-minute, this is now where we're getting into our execution time frame. Your execution time frame could be a time frame that allows you to minimize your risk. You can make it the 50-minute, you can make it the 1 minute, depending on the pair that you're trading and how volatile it is. Euro, you can probably have your execution time frame on the 1 hour because it's not too volatile. If you're trading a pair like gold, I would recommend 15, 5-minute, 1 minute personally for me, because everything else is just too wide of a pip gap. So taking a look right now, what we have here is we see price essentially breaking above this high, and now we're coming into the market. We know that we're going to be seeing more volume come in when the market opens. The New York session opens at about 8 a.m. Eastern. It is currently 7:55 right now. So what we do is we turn our attention to the next high right there. We know that if price is broken above this high, there is a strong likelihood that more buyers are going to be coming into the market, right? From a market structure standpoint, this is the first step. So simply what you do is you take your trade, or you identify what your stop loss is going to be. I usually do an average of 30 pep, and that's usually it with euro. But that's usually what I do on gold. With euro, you can probably get away with about 20-25 because it's not going to move that much. But overall, right, we're looking to target the next high. So right there, we're looking to see if we can risk about 25 to make 60 pep on this particular trade. And right now, what has happened is the market structure has been breached, so we can look for further continuation to the upside. And let's see what happens. So pretty much right there, we barely got any drawdown because the market was ready to move. We came into the market at the right time of day when there's enough liquidity and there's enough volume coming to the market. So it's really important that if you are going to go through the process of anticipating the market, you should be trying to do that when there is enough liquidity. When you're getting involved in your trade, you should try to do that when price is likely going to be moving. There's volume, there's liquidity coming into the market. So right now, price is moving in our favor, and we're seeing what price essentially does. So right now we are up around 30 pep on this particular trade. You can choose to take something off the table, move your stop loss to break even. How you want to manage the trade is entirely up to you. But in terms of what we did here, the very first thing is we identified who was in control of the market. We scaled down to a lower time frame, right? On the larger time frame, we saw that buyers were in control. We scaled down to the lower time frame, and we looked for a market structure break that supports, what the higher time frame is doing. And that's simply just it. So right now, we're in the trade, and boom, see what price decides to do. We can scale over to so there we go. It took some time, but we hit our main objective, and we just did that pretty much just based off of market structure. So market structure as a new trader coming to the market is probably one of the most effective things that you can use. So taking a look at gold right now on the 1 hour time frame, what we can see, when we make things smaller, is we can see that, okay, the market, we are in a uptrend, right? Buyers are in control of the market overall. Right now, we are just simply in a consolidation phase. But when you take a look at the little details, you can kind of see how price is moving from a market structure standpoint. And we were making lower lows and lower highs, lower lows and lower highs. And now we've switched from making lower lows to now making, a low right? A lower high and now a higher low as price decided to take out this high. So the minute the market did that, that tells you as a trader that, hey, you want to turn your focus over to this high right there, because price will likely be reaching for that. And if the market reaches for that, it'll likely be reaching for that as well. That's just the buyer and seller concept that we talk about. And what happens is the market starts to make high highs and high lows. So when you see this as a trader, your focus is not to try to be a seller in this, because that's not where price is going to be going. Your focus is to look to anticipate that, yes, there could be more sellers coming to the market, but you want to anticipate a buy, right? So there's always a period where you should be anticipating, which means you should be waiting. You should have your stuff mapped out, but you should not be looking to get involved before your execution. So right there, we see that we want to be a buyer because buyers are currently dominant, but sells are currently in motion right now. We come into the market at about 7:30 and we're just watching to see what price is going to do. So let's see, sellers are dominant, sellers are dominant. Okay, beautiful. Now what we're looking for is a clear market structure break, right? So if price is able to break above this high, that would give an opportunity for us to potentially get involved in the trade. And what we see here is the market has done that. So for me, one of the things that I like to do is I like to keep my stop loss at about 30, to 30, 35, 38 pep, especially with gold. Other pairs a little bit less because, they're not as volatile. So two things: when you get a market structure break, you can decide to be more aggressive or you can decide to be conservative. So being aggressive would be getting involved as price breaks out of this range, right? So price breaks out of this range, you put in your stop loss, and if your stop loss is at a set number, 30 pep, you would be placing your stop loss down, let's say, or 38 pep right there, right? Or 30 pep would be, right below this wick right there. But let's not be too aggressive. Let's be a little bit more conservative today and see if, okay, so if the market is going to pull back a little bit, give us an opportunity. Personally for me, this is already enough pullback. So what I'm going to do here is I'm going to set my stop loss at 30. I'll keep it at 35 pep, and I know it's spread, so we can do it at 38, just below this low right there, and look to target the next high to see if price is going to be, reaching for that, or even, somewhere along these lines. I usually do a minimum of 30 pep. So at 30 pep, I'll take my position. If this is a swing trade, I might leave it a little bit longer, but over here, this would be pretty much 100 pep, which is still pretty good for a take profit. So you have to manage your trade how you see fit, but let's see what happens. There we go. So within a few minutes, based off of the market structure break, price essentially hit the target. The other thing, guys, that you have to keep in mind is some pairs respect market structure a lot more than other pairs. Gold respects market structure really well. So before you start to use market structure on a particular currency pair, please test it, right? Go back in time and look at how market structure breaks really play out, right? Because some markets are a lot more range bound, choppier than other markets, right? Plenty of markets out there that market structure is not that big of a deal, but gold is very good. Euro USD is very good. If you're trading something more exotic, I would say try to just go back in time and see how price moves from a market structure standpoint before you start to implement a market structure strategy. All the way, we can see what happens afterwards, and price essentially dips down a little further. So didn't exactly hit 150, but price gave us pretty close to that. If we let the entire trade played out, we would have gotten everything that we wanted. But I'm a firm believer in trade management, managing your trade accordingly, so you put yourself in the best odds to take what the market gives you and you're not trading off of greed. So ladies and gentlemen, this is the video. When it comes to trading market structure, simple. It's not, don't overcomplicate it. Don't overcomplicate. Market structure is basic as basic can be, but it is extremely powerful. And if you pair with coming into the market at the right time of day when you should, when there should be liquidity, it is going to be extremely powerful. So this is what I'll say, guys. Watch this video a couple of times, take it to the chart. All you're simply looking for is to understand who is in control of the market, right? From a higher time frame perspective, if buyers are in control, you're looking for buys on the lower time frame. And one of the best ways is for a market structure break, right? For price to break above a high, pull back, and boom, continue moving up. That's it. Don't overcomplicate it. Show up at the time where there is going to be enough liquidity, which means you're coming in either at the start of a particular session. The London session is a great time. The New York session is a great time because they bring in a lot of volume and liquidity. And that's the video, ladies and gentlemen. Thank you guys for watching. Like I said, take it to the chart with you and watch this video a couple of times. We also have other market structure videos that we've done that can give you a little bit of a larger understanding into, the breakdown of market structure, and I will have that connected with this video. But as always, thanks for watching. I hope you're out there living free. Cheers.